Bitcoin has just delivered one of its sharpest moves in weeks, climbing more than 8% in a single session to around $72,000 and reclaiming the $71,000 level for the first time in weeks. And what makes this move particularly interesting is how quickly the market turned. A combination of short liquidations, falling bond yields, renewed optimism around U.S. crypto regulation, and a major move by the Treasury all arrived at almost exactly the same time, creating the kind of feedback loop that can turn a fragile market into a violent rally. Bitcoin's market capitalization has now climbed back toward $1.4 trillion, while Ethereum reclaimed the $2,000 level, and other major cryptocurrencies, including Solana, XRP, BNB, Hyperliquid, and Dogecoin, also moved sharply higher. But the most important question is whether the forces behind this move are strong enough to sustain it. Because underneath the price action, something much more important is happening in the bond market. The U.S. Treasury doubled the size of its long bond buybacks to $4 billion per operation, shortly after the 30-year Treasury yield surged to its highest level since 2007. That move helped ease some of the pressure in the long end of the Treasury market, with the 30-year yield subsequently falling back toward 5.19%. The impact of this move was instantaneous, because rising long-term yields have become one of the biggest sources of pressure across global financial markets. At the same time, U.S. government debt has now surpassed $40 trillion, highlighting just how difficult it becomes for policymakers to simply allow borrowing costs to rise indefinitely. Then came the leverage flush. According to CoinGlass data, more than 171,000 traders were liquidated over a 24-hour period, representing almost $3 billion in liquidations. The largest individual liquidation was an approximately $48.8 million Bitcoin position on Hyperliquid. In other words, as Bitcoin started moving higher, heavily leveraged short sellers were forced to buy back their positions, adding even more fuel to the rally. And this was happening alongside another potentially significant development in Washington. The White House brought together major crypto executives, regulators, and representatives from traditional financial infrastructure to discuss the future of U.S. crypto policy, including the Clarity Act. SEC Chairman Paul Atkins and CFTC Chairman Mike Selig were present, alongside representatives from NASDAQ, the NYSE, CME, Group, and DTCC. In this video, we will break down the latest commentary from some of the most closely followed macro and crypto analysts. Raoul and Lyn Alden are looking at this move from a much broader perspective, not simply as a Bitcoin rally, but as another piece of the increasingly complicated relationship between government debt, treasury markets, liquidity, monetary policy, and the emerging digital asset economy. If you find this analysis useful, make sure to hit the like button, subscribe to the channel, and turn on notifications so you don't miss the next update. Raoul Pal's latest tweet reads, "The Besant put today the U.S. Treasury doubled the size of its long-end bond buybacks, the day after the 30-year yield hit a 19-year high at 5.33%. The extra dollars are small. The signal is enormous. For the first time, the fiscal authority, not the Fed, stepped in to defend the long end within 24 hours of the highs. There is now a put under the long bond, and the market has just been told the top of the range. Look at the plumbing underneath it. The buybacks pull old illiquid bonds off dealer balance sheets and get funded at the front end with bills, which the banking system absorbs. Duration out, money like paper in. Lower long-end volatility raises the collateral value of every treasury in the repo system, which is itself a liquidity easing." Powell then connects this move to a much broader set of developments involving global dollar liquidity, Japan, foreign treasury demand, and the Federal Reserve. It isn't happening in isolation. This month's joint yen intervention was about stopping Japan from ever becoming a forced seller of treasuries, and the new dollar swap lines across Asia and the Gulf keep the region's dollar debts rolling, with China the ultimate beneficiary. A weaker dollar is the tool that brings the big foreign buyers, Japan and eventually China, back to the long end. Supply managed on one side, demand rebuilt on the other. With a long end now potentially anchored, the steepening of the curve should come from Warsh, who will probably deliver his part of the grand bargain between the Fed and the Treasury. His argument is that the current environment cannot be understood by looking at Bitcoin. the Fed Treasury yields or government debt independently. They are increasingly connected. The U.S. government has enormous financing requirements, while the private sector is simultaneously embarking on an enormous capital spending cycle around artificial intelligence and data center infrastructure. That means the financial system needs to accommodate both a huge public borrowing requirement and a huge private investment requirement. And Powell believes liquidity is ultimately the mechanism that makes that possible. This is the everything code fully at play and brings together many threads I've been talking about for the last 2 years. The debt must be serviced, and liquidity, by whichever mechanism they can route it, is the method. Overall, today was a big marker point on a story that I've been predicting for many years and have the receipts to prove it. The outcome is always more cowbell. And that brings us directly to Lyn Alden, who offers a much more concise interpretation of the Treasury's move, but it points toward essentially the same underlying problem. Her tweet reads, "The impacts of Treasury buybacks are often overstated and sensationalized, but the signal here is that the scent is Yellen. Everyone who comes into power blinks once they encounter the fiscal train. Doesn't matter what they said before. Administrations can campaign on fiscal discipline. They can promise higher interest rates, tighter financial conditions, or less intervention. But once the cost of servicing the debt becomes large enough, those promises run into the arithmetic of the system. That is Alden's broader nothing stops the fiscal train thesis in action." Alden followed that argument with another observation. While everyone freaks out about bond yields and losing the long end, the funny thing is that the yield curve isn't even steep. Whether you look at the 10-2 or 30-5 or 30 versus cash, T-bills, long bonds just aren't paying enough extra yield to entice buyers. This adds another layer to the bond market problem. The issue is not simply that long-term yields have risen. The market also has to compensate investors sufficiently for taking on duration risk. If the extra yield available from holding longer-dated treasuries is not attractive enough relative to short-term instruments, investors have less incentive to move further out along the curve. And that creates a difficult environment for a government that needs to issue enormous quantities of debt, while the bond market was reacting to the Treasury's intervention. The White House was also hosting a meeting that could have enormous implications for the U.S. digital asset industry. Crypto executives and financial market representatives gathered with senior regulators to discuss the next phase of crypto legislation. And Coinbase CEO Brian Armstrong made the industry's priorities very clear.
Well, this morning I was thinking back to the 2024 campaign where the president, I think, very astutely recognized there was millions of voters in the United States who felt disenfranchised by the prior administration. And he made a commitment at that time to make America the crypto capital of the world. And within weeks of taking office, delivered on that promise. And it started first with this executive order, which came out ordering the agencies in his administration to take steps in this direction. Shortly thereafter, appointed two of the most competent and pro-innovation regulators anywhere in the world, Chair Selig and Chair Atkins, and of course fired Gary Gensler. There was that big applause line at the Bitcoin conference, which was powerful. And of course, the Genius Act was another milestone just in the past year, along with the Strategic Bitcoin Reserve, et cetera. A whole amount of progress has been made, and I think what's most important next, of course, is this September 15th vote that we have with the Clarity Act. This would make all of the progress that this administration has made durable into the future, so it could survive for decades and decades to come. And make no mistake, there are folks out there who they want to see this legislation not happen, right? Maybe some of the big banks don't want the competition from crypto companies. Other banks are leaning in and have endorsed it, which I think is really powerful. And so if we all come together, I think we can get this bill over the finish line and hopefully get more than 60 votes come September 15th. Thank you.
If the Clarity Act advances with strong bipartisan support, it could give the digital asset industry something it has lacked for years, a more durable regulatory framework. Armstrong took the bullishness a step further in a tweet which reads, Vision Board, 1. Strong bipartisan vote on Clarity September 15th. 2. October 3. Next crypto bull run begins. But there was one statement from the White House summit that potentially matters more than everything else. For years, Bitcoin investors have talked about what would happen if the United States government moved from simply tolerating Bitcoin to actively accumulating it. Now, that possibility is being discussed at the highest level of government. During the White House Crypto Summit, President Trump said the United States is considering buying sizable amounts of Bitcoin and other cryptocurrencies. That is a very different proposition from simply maintaining the Bitcoin already held by the government. The United States already has a strategic Bitcoin reserve framework. But the question of whether the government would actually use new funds to substantially increase its holdings has remained one of the biggest unanswered questions surrounding the policy. Trump's latest comments put that possibility back at the center of the conversation. And if the word sizable ultimately translates into a meaningful accumulation program, the implications could extend far beyond the immediate amount of Bitcoin purchased. Because governments do not normally treat assets as strategic reserves without changing how those assets are perceived by the broader financial system. Gold is the obvious historical example. Once an asset becomes something that sovereign governments are willing to hold as part of their reserves, the investment thesis changes, and Bitcoin is already moving in that direction. What makes this particularly interesting is the timing. This is happening at the same moment that the Treasury is becoming more sensitive to long-term borrowing costs, financial conditions are beginning to ease, and Washington is pushing toward a comprehensive regulatory framework for digital assets. So the story is no longer simply that Bitcoin went up 8%. The story is that multiple layers of the U.S. financial system are moving closer to Bitcoin at the same time. Trump also called on Congress to pass the Clarity Act, reinforcing the September 15 vote as one of the most important upcoming events for the industry. Trump also emphasized that the United States intends to remain the undisputed leader in Bitcoin and crypto. If you enjoyed this breakdown, hit the like button, it helps the channel tremendously. Subscribe if you want more deep data-driven coverage of Bitcoin, crypto, liquidity, and the macro forces moving these markets. And turn on notifications so you don't miss our next video. Thanks for watching.